If you invested $20,000, $10,000 in Amazon, $10,000 in Apple in 2004, and you did a Rip Van Winkle and went to sleep for 20 years, you would have woke up December 2024 with $8.6 million. $20,000 would have grown to $8.6 million in a span of 20 years. I came out of 2020 with the belief that Broadcom and Nvidia will yield the same results, if not better, over the next 20 years. 5 years later, it's been about 5 years now, absolutely nothing has changed with my opinion on these two companies. Today we're just going to talk about Nvidia though. So now over the last 5 years, the index or the market, the S&P index, whenever I say the market, I'm always talking about the S&P index. The S&P index is up 103%. Over that same time frame, the last 5 year Broadcom is up 601%. And Nvidia is up 1,500% over the last 5 years. There's been tremendous growth. So before we go back into those, let's look back at the Amazon and Apple thing, what I talked about growing to $8.6 million. Now, you would have gone through 2008 when both of them were down 55%, or the holding was down 55%, and your balance of your portfolio would have dropped from $202,000 down to $89,000. Now, did you lose over $100,000 during that time frame? That all depends on your perspective. Everybody always fear like losing money in the market. So when their portfolio starts going down, they feel like they're losing money in the market. But did you really lose money if you didn't sell anything? You can go up to 2022 when they were down almost 30%. The portfolio value would have dropped from $6 million to $4.3 million. Now, did you lose $1.7 million in the market if you did not sell anything? You see what happened in the next 2 years. It's all about perspective. So when times like this is happening, when there's a lot of volatility, people get worried about the market and what's going on. So Nvidia, Broadcom, and a whole host of companies right now are having volatility. They're having sell-off. Stock prices are decreasing. So you can look at the value of your portfolio dropping. Just because there's a temporary drop in your portfolio does not mean you have to go out and do anything if you are invested in good businesses. So before we talk about Nvidia, we have to go back to 2021 when I first wrote this about Nvidia. This was May 28, 2021. I said Nvidia has a 5-year average growth of almost 45%. That's the earnings per share. 27.2% in revenue, 46% cash flow. The revenues were $6.9 billion in 2017 and $16 billion for last year. The total assets were $9.8 billion in 2017 and now we're up to $29 billion. And that was in 2021. So we'll revisit that in just a second. The best companies to own are the ones that can compound at a high rate over long periods of time. Nvidia is one of those companies. A couple of months later, what happened during the 2020-2021 area or time frame was there were a lot of meme stocks that were shooting up really, really fast. They had no earnings, no revenue, no cash flow, but the stock was going up. And the Bed Bath & Beyonds, the Beyond Meats, the Pelotons, the Neo, the Rivians, what else? Moderna. There's a whole bunch of them. They were just AMC, GameStop. They were just shooting up to the moon. But the companies had no earnings. I never bought any of the meme stocks because at that point in time, because of the studying that I had been doing, I knew that I was only going to look for the outstanding businesses. So when somebody asked me about the meme stocks and jumping in and out, I wrote this. I said, I can't help you with that because I don't play that game. I'm not smart enough to know when to get in and out of companies like that. That may cause me to miss some hot stocks, but I'm okay with that. The reason I bought Nvidia, Broadcom, Apple, Amazon, etc., was because I thought they were really good businesses selling at a decent price, which could compound my money at a high rate for many years. Now, here's a kicker. I don't invest based on what I think a stock is going to do in 1 week, 1 month, or even 1 year because I have no idea. And neither does anybody else. Neither does anybody else. You have all these people prognosticating. I think I said that right. Prognosticating about what the stock is going to do, what the market is going to do, and how you should jump in and out and move. They don't know. They're just guessing. They're speculating. But some people have an economic incentive to make you think they know, so that every time you move money around, they get paid off of you. I said at some point, Nvidia is going to go down 30 to 40%, but I own a piece of what I believe to be a great business that I have no intention on selling, regardless of what the stock does. Even right now, today, Nvidia was recently down 30%. I think right now it's still down greater than 20% from its all-time high. But so people are saying, okay, what should I do? Should I sell it? Should I sell it now and then wait till all this volatility ends and then try to buy it back and do all this stuff? Or should I sell it and buy something else? Should I take it and lock in profits? Well, what I would do is the same thing I did the last time. So right after I wrote this, a month later or a couple of weeks later, Nvidia began to go down. So from 11/21 all the way to October of 2022, not only did Nvidia go down 30% or 40%, it went down 66%. 66%. Now, that didn't cause me to freak out. That didn't cause me to run for the hills. In fact, what I did was I kept buying Nvidia. I bought it all the way down. You can see here, 11/22 at the bottom. It was $338 a share. By the end of January of 23, it was at $195. So it went all the way down to the lowest price I bought it was on 11/23 or 9/19. It was $132. So it went from $338 all the way down to $100, $130 a share. But I kept buying it because I am buying a piece of the business. And we'll look at the business a little bit in a second. So that whole time, that period, you can see that it was a total of $8,063.43 that was invested. So now let's look at the results of that as of today. So that $8,063.43, during that time I went through and did the math, I ended up buying 42.8286 shares. And the cost of that, the average cost of all that purchasing was $188.27. Now, Nvidia last year did a 10-for-1 stock split, so that makes the shares $428 and 428 shares rather. So the average cost, if you divide that by 10, is $18.83. So the average cost was end up being in today's price is $18.83. And those 428 shares, the average today's price or the current price was $114.06. So those shares that I bought during that downfall or during that sell-off are now worth $48,850.30. Now, I didn't do anything. There's nothing I had to do to make that to grow. Now, you look at it and you say, oh, it grew by $40,000. I don't want you to look at it like that. Investing is about doubling. Or compounding is always about doubling. It's a doubling factor. So they didn't just grow from $8,000 to $48,000. So it didn't just grow about $40,000. It doubled 2 times on its third doubling cycle. So 8,000 doubles to 16,000. 16,000 then doubles to 32,000. And then 32,000, the next double goes to 64,000. So it's on its third doubling cycle. That's how compounding works as a doubling factor. That's why when investing, your money grows exponentially. That means if I had invested $50,000 at that particular point in time, that $50,000 would have doubled to $100,000, and then that 100,000 will double to 200,000, and now it would be on its third doubling cycle on its way to $400,000. So probably somewhere around 300. So it would have grown by 250. That's how compounding works. Yeah, I said I would go back and look at the aspect. When I wrote down that the revenues was 6.9 billion in 2017 and 16 billion for last year in 2021. Now, if you look at it, the revenues have grown all the way from that 16 billion to last year, all the way up to $130 billion. So when I first wrote this, the revenues had grown from 6 billion to 16 billion. Now it's up to $130 billion in revenue. That's what Nvidia is generating. That is tremendous growth. That is what you're buying. You're not buying a $114 stock. You're not just buying a $114 stock. You are buying ownership in this business that is growing at an exponential rate, and all you have to do is sit on your behind and do nothing and leave it alone. The cost of revenue, the cost to generate that revenue is $32 billion. So the gross profit recently was $97 billion. Then you take out the expenses for operating the business of $16 billion, and then you have operating income of $81 billion. That's the operating income of $81 billion. Also, I put the total assets were $9.8 billion in 2017, and they were up to $29 billion by 2021. So they've grown from $29 billion up to $111 billion in total assets, with only $32 billion in total liabilities. That is tremendous. That is tremendous. You can actually look down at total debt of $10 billion, but they have cash and cash equivalents of $43 billion. So if you own Nvidia, you own a company with total assets of $111 billion, with $43 billion in cash and cash equivalents on the balance sheet. That's what you're buying. You have to change your mindset away from somebody who's buying a stock or a $114 stock to you're buying ownership in a business that you can own for 10, 20, 30, 40. Who knows how long you can own these businesses? You can own them for a long, long, long time, and you participate in the growth. As this business continues to grow, you participate in that growth. You also look at the operating cash flow. This is from the cash flow statement. The operating cash flow, you can see in 2022, it was $9.1 billion. Recently, it was $64 billion. That's the cash from operating the business. So the cash flow from operating the business is $64 billion. You can see in 2022 and 2023, there was a difference where it dipped down. But it's not about what happens 1 year versus the next. You're looking at businesses over a span of years. And one of the things that stands out to me is you look at the very bottom is free cash flow. I'm a big fan of free cash flow. You see the free cash flow is $60 billion as of last year. And free cash flow is the money that a company has left over after paying its operating expenses and also its capital expenditures. The more free cash flow a company has, the more it can allocate to paying down debt. That money can be reinvested back into the business. That money can be used to pay dividends, or it can be used for repurchase or buying back stock. As you can see, that's a way that companies return capital back to shareholders. They pay dividends to shareholders, or they buy back stock. Nvidia buys back stock. Last year, they bought back $33 billion in stock. So remember, things are calculated based on outstanding shares. The earnings per share is based on the number of outstanding shares. So by them spending $33 billion, they take shares out of circulation, which decreases the number of outstanding shares, and it also increases your interest in the business. So that tends to help your money to grow from that standpoint. Now, if you look at what the analysts recommend, so we're looking at this. Now, as you can see on this particular one, the stock price is $106. That was like one day to the next. So one day is $114 per share. The next day is $106 a share. The analyst recommendations there, all 63 recommended it as a buy. The average price target is $171. So that's the average price that they predicted it'll be 12 months from now, $171. So with the high being 220. I have no idea what the stock price is going to be 12 weeks from now or 12 months from now. I do know that I'm going to own it 12 months from now. I do know that. Another thing that I always look at is profitability, and the management effectiveness. You can see Nvidia has extremely high profitability metrics, 55% profit margin, 61% operating margin, return on assets, 57%, return on equity, 119%. If you get these 10, 15% or higher, or return on equity greater than 20%, you're doing great for different companies. But these numbers are tremendous. What I'm going to do is I'm going to contrast these with Intel, which is the same company that shows stocks are not the same. All stocks are not the same. If you look at Intel here, you see the stock is $19.75. You think, oh, Intel is cheaper. Maybe I should buy that. But you look at profitability. This profit margin is a negative. Management effective, return on asset, everything is negative. There is one hard rule that I follow that I will not break, and I learned it the hard way, is that I would never invest in a company that has negative profitability or management effectiveness or extremely low numbers in this category. I just won't do it. Now, if you look at Intel from a revenue standpoint, in 2021, the revenue was $79 billion. Then it was $63 billion in 2022, $54 billion, and then $53 billion in 2024. When you look at that, is it a growing business? No, that is completely opposite. Don't invest in businesses that aren't growing. You have to look at more than just the stock price. You got to look at the business and how the business is doing. You see down the highlighted area, the net income that's available to shareholders, it's negative $18 billion. That's the net income for the shareholders. Operating income is negative $4.7 billion. So you got a company that's losing money and versus one that's growing. And it's in the same field. This is a technology company. So companies are not the same just based upon what field they're in or what sector they're in. All right, the last one I look at is you look at Intel, the last one here. You look at the top column, the operating cash flow. In 2021, it was $29 billion. Then $15 billion. Then 2023 is $11 billion. Then 2024 is $8 billion. So you see that the cash flow that's coming in from operating the business is getting less and less and less. And then you look down at free cash flow. You can see it was $9 billion in 2021. And it's a negative $15 billion last year. I wouldn't touch Intel with your money. I wouldn't invest in Intel with your money. So that is the difference. You want to own good businesses. And the best thing to do is you have a business like Nvidia that's growing, a business that's, you can see the revenue is growing, the cash flow is growing. You don't have to do anything. Some people want, I gotta sell it now and I gotta buy it when it's cheaper, or I gotta rebalance my portfolio. I need to sell some Nvidia and take some profit. Take some profits and do what? Are you gonna find a better business to take that profit and put money into that's gonna grow your money and increase your wealth and increase your family's wealth at a better rate? If you do, I would love to know it. Put it in the comments. So, and I look at Broadcom and Nvidia as tandem. I buy both of them in tandem. So those are my top two. Those are the best two businesses that I own currently. And they are growing faster than anything else. And then there's no reason for me to sell them. Why would I sell businesses that are growing my family's wealth? And I can look at the business, the balance sheet, the cash flow statements, the income statements. They recently had their earnings. I don't care what the stock price does. That has zero effect on me and what I'm going to do. Yes, I will continue to own Nvidia, and I'll talk about Broadcom tomorrow. So now you can do what you want to. This is not investment advice. I always got to put this disclaimer because I'm not a financial advisor or anything. So you always have to do your due diligence. And this is just some information I wanted to share with you so you can go do more research on your own. All right. Until next time, Have a great day. I'll talk to you later.